Stu Morrow joins us to kick things off this hour. He's an investment strategist at Morgan Stanley Wealth Management. Stu, good morning to you.
Good morning, John.
Okay. It's always the same recipe, just the order can change and the mood of the markets clearly is different these days. What's been your assessment of what's been happening?
Yeah, I think it's important also to have some perspective too. And you know, there is a lot of volatility that's been picking up in the last several weeks. If we look at equities in the U.S., which seem to have peaked at the end of the second quarter earnings season, you know, on the back of what has been concerns around the U.S. debt, the debt ceiling debate, more recent news around you know, volatility in the governance side of fiscal policy in the U.S., having to elect a new House Speaker. Concerns of the bond market have been expressed through a higher term premium. So we're starting to see that come through. And this is all at a time, John, when we're seeing the U.S. Treasury issuance start to pick up. So the schedule of new bonds coming to market is growing. So the backup in yields, as you said, is having an impact on the equity market. And this is something we've talked about for some time, this disconnect between where interest rates have moved, real interest rates, and where valuations have moved. And I think the reality check for the market is starting to happen now.
At the same time, listening to you explain some of the factors behind the bond market moves, there's a lot of mechanics there. And, you know, when there's real uncertainty, and many have lived through these moments in the markets, when you're watching price action, you're almost sitting there feeling like, is it ever going to stop? This so far has not felt like one of those moments. It feels like it is the uncertainty in the air that is driving uncertainty in the markets.
There hasn't been that capitulation yet. So, you know, when you look at the technicals of the market, certainly they've been weaker over the last several weeks in both the equity side and the bond side. But we haven't had those days of capitulation that sort of says investor sentiment is, you know, we're sort of throwing in the towel, which to us is another sign of, you know, where's the next leg of the market going? So, you know, until you get those signs from a technical basis, from a fundamental basis, I think, you know, we're going to continue to grind lower here in both the equity and perhaps the bond market until we get signs that we're towards the end of this rate cycle and the Fed and the Bank of Canada are done raising interest rates.
I mean, this would appear to be the time when the pros, you know, earn their money. I wonder what you're doing in this environment. How are you approaching it?
So we're defensively positioned in our portfolios. We have been for some time. That hasn't changed. So from a tactical basis, Morgan Stanley Wealth Management, we're underweight global equities, principally underweight U.S. equities, and we've talked about this before, the disconnect between valuations and interest rates on the S&P 500. So we've been telling clients to think about rebalancing away from market cap weighted strategies to more equally weighted strategies in the U.S. Elsewhere in the portfolio, being overweight fixed income and cash. You know, as we're towards the end of this rate hiking cycle, as we're potentially entering a soft landing, a recession environment, that's typically a period where bonds provide that ballast to the equity side of the portfolio. You know, I would say also, you know, investor behavior is important at times like this. There's a lot of noise, there's a lot of uncertainty in the market, and you know, one great portfolio manager once told me, you know, Stu, the money you manage is like a bar of soap, right? The more you touch it and play with it, the smaller it gets. So I think controlling what we can control as investors is important at times like this.
And you know, there's, I guess, to feed off of that, you know, people often like to show those charts of if you miss the best days in the market over the course of a year or a decade, it also means difference in performance. I wanted to bring back a chart we used in our opening today, which is the expectations for earnings. You talked about the disconnect, but I guess we're going to find out soon whether or not companies can deliver or not. And you talked about going more equal weight in the U.S. I'm not going to put words into your mouth, but it sounds like you are saying lean against big tech. The argument I've heard for sticking with big tech is if the economy cools down, these are the only companies that you can have confidence in knowing how to make money for the foreseeable future.
It's possible, but then if you look at the valuation side of certain parts of the tech group, you know, I think they've gotten ahead of their skis, relative disconnect to where, you know, bringing forward a lot of good news on certain parts of the information technology sector. I think we're at that point now. Third quarter earnings are going to come in, and I think what's important to watch there, John, will be the guidance. The guidance going forward as we look at the fourth quarter and into 2024, that's when I think we start to see estimates for both the top line and margins for the S&P 500 start to come back.
And then a real quick word on the TSX itself for anybody who's curious. I mentioned it's in negative territory for the year now.
Yeah, so TSX, I mean, we know we're resource dependent, heavily materials and energy, financial services as well. So if we looked at the earnings revisions that have gone on in the S&P TSX over the last year, we see financial services start to back up. You know, there's potential for more earnings revisions to come on the negative side for the banks. On the energy side, of course, WTI and Brent have been doing quite well over the summer. So we've seen a positive revision on the earnings side for energy. And then material side's a bit mixed. So, you know, for us, we're about neutral in Canada. We're not advising clients to take a big bet either way.